Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The first of two major USDA reports was released yesterday, with the next one due at the latter part of the month. The data that was released was perceived as bearish by the trade, and as we can see in the chart here, prices did come down significantly, but managed to recover about half of its losses by the end of the day. We find that from last week, we had a projected possible high coming in around the 5th or 6th of the week, and the market marched up right up against that dotted vertical line, which was our time factor, and the market made its top right on top of that projected level. From there, the market also found resistance up against one standard deviation below the point of control at 363.5, and from that point forward, the market had been in a steady decline. Today, the market continues to digest a bit of the news from yesterday and continues to trade well below the opening prices we saw from Monday. From here, we anticipate that the market will find a low perhaps sometime this week or sometime in the middle of next week, at which point corn could then start to mount a potential rally. Our next date of significance sits somewhere in the neighborhood of September 19th to the 21st, but between now and then, we anticipate that corn will continue to be sideways to slightly lower, perhaps with the possibility of eclipsing the previous significant low near 345. That resistance level from last week coincided with our 270-degree price factor at 363.25, and the market again found very good resistance there. From there, the market did make its way down, and we do have potential support sitting at 344.5. And if the market's able to break this 344.5 number this week, we anticipate a final target somewhere close to 335 to 340 for the corn contract, perhaps sometime next week. Last week, we shared that the November corn contract had potential resistance sitting between 979.25 to 984. And as we can see here, that resistance level held up very well. We calculated that resistance zone by taking this initial range and then taking that range from the previous low and expanding it 1.618 to 1.786 in its expansion. We can see a potential time factor zone coming in sometime at the later part of this week where the downdraft may in fact come to a pause, and we're looking at potential support coming in near 938 to 939. The initial reaction for beans was very bearish yesterday, but as we can see today, we're seeing a bit of recovery off of the move that we saw from yesterday. The time factor is going to be key as we look to see where this market responds from here. We anticipate that the market can be down to sideways for the next couple of days, and at which point, if it does find very good support near 939, 940, the market could in fact then continue to creep up from there. We continue to believe that in all likelihood, soybean will continue lower till about mid to late October, but the way in which it responds over the next week or so is going to be very telltale. If this market's able to get back above this previous resistance that we had established from last week, sometime in the middle of next week, all bets are then off and soybean perhaps may find some legs earlier than expected. Resistance last week and support this week comes from volatility-based support and resistance, and we can see as the market traded up against resistance, the market did fail. And yesterday, despite having a very big sell-off, once the market hit volatility-based support, it bounced up from there and recovered about half of its losses. Today, we're a bit sideways, trading right inside of yesterday's range. And we can also see that we have the 270-degree mark at 952.25, establishing itself as potential support. So today, our view would be that if the market closes above this 270-degree mark, that we could see some continued strength for the balance of the week. And if it closes below this 270 mark, we anticipate continued weakness in the coming days. On August 29 last week, December wheat made a significant low at 322.5. That low happened to coincide with our time factor of August 28th. And in addition to that, we had used the arc swing technique that we have shown you time and time over again to project where that low could come in. We took a swing from the mid-July high and took it all the way down to the previous April low. And what we did there is we simply took the market swing, and in taking that swing, we used the actual tangent of the low of that arc or the circle that was formed, and the price of that tangent line came in at 424. At which point we were able to determine that 424 was possibly a level of significance for this contract. From there, we can see that the market made a significant low. Both time and price came together, and the market has moved up from there. Additionally, we can see that as the market actually made its way back up close to that arc swing itself, it found good resistance up against it and has fallen from there. The market found good support at a 2x1 angle after responding to the upside to yesterday's USDA report, but today we can see that early intraday gains that were initially made have now been surrendered, and the market is trading at the lower portion of the day's trading range. From here, we anticipate that wheat in all likelihood will continue lower, and we're looking for the market to at least retest previous lows. We're looking for a low to come in sometime in the middle of October for this wheat contract, but that can potentially occur beforehand. One standard deviation below the point of control rests at 444.5, and that is perhaps why this market is finding a bit of resistance up against this level here. If it is able to get beyond this 440.5 number, we're looking at potentially somewhere in the neighborhood of 450 as being good resistance. We had previously shared that somewhere between September 5th and 6th could develop into a time factor where the market would reverse its ways, and that's exactly what happened as the market made its way up to the end of this shaded region where we projected a potential reversal. The market came up into this area and has since declined a bit, although it was right in the middle of key support and resistance, suggesting that the market may have one more final push. We would have preferred that the market had been right up against one of our key resistance levels for a very clean sell, but even still, the market did decline for about 3 to 4 days coming off of that projected timeline. Downside support rests at 434.25, and we have overhead resistance near that 455 number that we just mentioned. If the market's able to make its way up to about this 180-degree price factor, we anticipate that it would find good resistance here potentially, and then perhaps look to make its way down. We have a downside projection of about 413.5 coming in at the 360-degree mark, which would allow it to satisfy coming into a full cycle area. Crude oil futures came up into volatility-based resistance last week, and as it made its attempt to try to test the 180-degree mark at 51 once again, the market did fail, and as we can see, the market declined for about 2 to 3 days. It has since been moving up from there, and we can see now that the market has found support up against that Fibonacci retracement area of 47.68. So the market came down and made a slight test of that area and got pretty close to it, and is now looking like it wants to march its way back up again. Again, that 51 mark continues to be very important for this contract. And upon breaking this 51 number, this is where we believe that the market will then be able to find some legs and then look to test 52.80 and possibly get up as high as 54.75. If the market fails at this 51 number once again and comes down and breaks down below 46 and change, we then do believe that the market is poised to retest the previous low at 43.08. Hurricane Harvey and Hurricane Irma have now come and gone, and in doing so, helped to propel cotton futures all the way up to our final target space of 75 and change. The market ran up to that area, found very good resistance as it retested previous highs, and from there we can see huge volatility in the opposite direction now that profit taking in great numbers has begun to take place. The market has fallen back down right up against one of our quartile levels where it's found a bit of support, but from here would be looking to sit on our hands waiting for a next opportunity to develop. We find that the 90-degree factor of $91 that we had shared last week appears to be a level of significance, and the market has been moving up from this area. Today we can see great strength in the dollar. If we're able to close above the 270-degree mark this week, we believe that the US dollar then is poised to potentially continue higher and finally post that corrective move that we've been looking for over the past couple weeks. Key resistance right now sits at 93.45, and the way in which the market responds in the event that it's able to make it to this area is going to be very important. Following this 93.45 number, we would then be looking at 93.88. And upon breaking this 93.88 number, we believe that the corrective move would then be confirmed, and the market would then be potentially well on its way for that corrective move that we suggested earlier. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.